Okay, the numbers are just out for 2026. The IRMA is income related monthly adjustment amount. It's the Medicare tax on high income people. And I would like Tom, I want to push it to Tom, and I want Tom to share why are we doing this video?
Yeah, I mean, we're doing this video because Medicare is confusing, right? I mean, everyone who walks through our doors who's going on Medicare has some level of things they've missed or they haven't understood. And then on top of that, we add this IRMA, this increased cost for Medicare based upon your income. And by the way, they use your income from 2 years ago. I mean, it's crazy. And so what we want to do today is really walk through what IRMA is, how it affects you, what you can do about it. And by the way, it's about 8% of people on Medicare have to pay this, and this might be you if you're watching this video. And so I want to bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board as always, and so some people print this out, look at it, because if you're on your phone, the screen when we go back to the show will probably be pretty small. These are sort of the notice from Medicare about what the IRMA charges are. We'll go over that as we go through the board. One of the forms here is the way to appeal the IRMA. So there is a possibility to appeal it if you get assessed this higher cost. We'll walk through how to do that and when that's appropriate. One thing I'll point out is at the filming of the show, they haven't released the 2026 version of the form. So again, these are older numbers. But the appeal will still work even if you have the wrong numbers on there. So go back and reference this part of the show notes for the correct numbers where the brackets are, and then you can use the appeal form to file it. So we'll get to that as we go through the show. So let me turn it back to Hans, and then we'll walk through sort of the board here and give you guys all you need to know about IRMA.
Okay, so the government has a whole bunch of acronyms and everything they're doing in the tax system, Medicare. So IRMA is income related monthly adjustment amount. That means we're going to charge you more if you have a high income. That's just translating that. And then the second word or acronym that you need to learn is MAGI, M-A-G-I. And a lot of folks know what AGI is, adjusted gross income. And, I think it's line, Tom would probably know this, but a specific line on your tax return is your AGI. And a lot of things are based upon that. And for the Medicare people, they've got an extra M stuck on there as modified adjusted gross income. And when I was getting ready for this show, I went into the dictionary or Google, and I said, okay, what are synonyms of modified? And guess what comes up is adjusted. Then I went backwards and I said, what are synonyms of adjusted? What comes up is modified. So, I mean, they mean the same thing. So it's adjusted gross income. And they're just playing games with you. All the modified does to your adjusted gross income is it adds back in tax-free bonds. So when IRMA first came out, they didn't have this MAGI thing. And so a lot of people that had interest earning investments, they shifted a lot of them to tax-free bonds. So they didn't show up in the calculation for AGI. And then they got out of IRMA. And then that took them a few years. They came out with this MAGI. So in any case, you got to come up with a little bit different number to calculate for your 2024 tax return. Because, what I'd ask all of you, and I asked our producer before the show, what can you right now, when you watch this video and you say, what can you do about your 2024 tax return? And of course, the answer to that is nothing, because it's the end of 2025. I filed it back in April, but I couldn't do anything about it in April either, other than file it, because everything that happened for income already happened in 2024. So the government is using old numbers that you can't do anything about to calculate in the future, 2026, what they're going to charge you for your extra Medicare premium. So it really feels like a setup to a lot of people the first year this affects them, or the first time they're learning about IRMA. But it just is. And so they're going to use the 2024 return, which has already happened. There's nothing you can do about it. And they're going to find, whether you're single or married filing jointly, where you fall, where your MAGI, M-A-G-I, falls in this list. And then you're going to find out how much you're going to have to pay. Now, there are some things we can do about it. Before we get into that, I want Tom to go in and just explain this chart a little bit to you.
Yeah, so like Hans mentioned, they use your 2 years ago tax return to determine how much you have to pay for Medicare. Not that it really matters, but the reason they do that is that's the tax return they have on file, right? If you think about it, you start 2026, you haven't filed your 2025 tax return yet, but you have filed your 2024 one. So that's why they use it. But the problem is, like Hans mentioned, is now there's nothing you can do about 2 years ago tax return. And a lot of times, especially people who are just approaching Medicare, if they're not watching our channel or they're not really reading up on this, they have no idea this is coming, right? They're doing things back when they're 63, Roth conversions, taking money out of their 401k. I mean, doing all sorts of things, selling real estate, having no idea that it's going to impact their Medicare cost 2 years from then when they're turning 65. And so again, my hope is that we have at least helped you know that it's coming, not necessarily to avoid it at all costs, but at least you're prepared for it when it gets there. But what they do is they look at your adjusted gross income plus the tax exempt interest, with the tax-free interest from generally municipal bonds is what produces that. They add that together, and then they look at this chart, right? And one thing to also remember is that adjusted gross income is before you take the standard deduction. It's before you have itemized deductions. And so even if you have, like, if you're really charitably inclined or you've done some other strategies around reducing your tax bill, that might not necessarily have impacted the adjusted gross income. So that's sort of an interesting thing to keep an eye on. But they look at this chart and they determine how much you have to pay for Medicare. So I'll take a single tax filer, for example. So if you are, and again, these are 2026 numbers. So in 2024, if your income was below $109,000, that's all you really need to know about. It's like, I'm not going to face any IRMAA. Your Part B premium will be $202.90. That's again over on that right side of the board is sort of the total Medicare. And again, one thing to know, this is just the Part B premium. This does not include your cost for your Medicare supplement. It does not include the cost for the drug plan. There's a separate IRMAA charge on drug plans as well. That's not what we have on the board here. So this 202, that is just your access to Part B of Medicare. If you're still working, you can delay Medicare. If you're still working, you don't need to worry about this because you haven't signed up for Part B. Again, we have other shows on Medicare, but just know that you don't always have to sign up at 65 if you have what they consider credible coverage. But you're at 109. The Part B premium is 202. One of the sort of tricky things with IRMAA is it's a cliff. So if I was at 109 and $1, I went $1 above that threshold, the 109. Now we go to the next bracket up, and now my IRMAA is $81.20 additional to the 202. So the total cost would be the $289.10. And I guess we do have the Part D IRMAA as well over on that far right. There's another $14 there. So the total Part B would be $289, and then the Part D IRMAA would be the $1450. So again, the total Medicare cost, Part B and Part D IRMAA, would be the $298.60. And so that's sort of how to read the chart. If you're a married couple, the thresholds are higher, right? So you get 218. If you're below 218, no IRMAA cost. If you're above that, then you start looking at the brackets that you're in and seeing how much you have to pay there. If you're a couple and you're both on Medicare, multiply these numbers by 2 because you're both having to pay this IRMAA cost. It's not on the board here, but I will just caution you, if you are married and you're living together and you're filing separately tax return, those IRMAA charts are really, they penalize you quite a lot for doing that. So be careful if you are married filing separately, because you could have a real shock on the IRMAA cost there. So again, we could talk all day about sort of the intricacies of this, but that's again how it works. And again, just as going back to this, is they're using your income from 2 years ago. I do get this question a lot, is do they reevaluate that? And the answer is yes. So it's always on a 2-year rolling basis. So 2026 looks at 2024 income. When we get to 2027, they'll be looking at 2025. So if you have a single year with a high income and there's nothing we can do about it if we can't appeal it, which we'll talk about in a second, you might have IRMAA for 1 year, but if your income drops off, then it goes away. So it's not like you're stuck there forever, but it is. They reevaluate that every year on a 2-year sort of rolling basis.
Okay, that's the time of year, which is now right at Thanksgiving. You're going to get a letter in your SSA.GOV account, and you're also going to get a letter in the mail, and your spouse is as well. if you're under IRMA, that's going to actually do all these calculations for you. So they're going to send you this love letter that says this is how much you're going to pay for Medicare, or how much extra you're going to pay for Medicare in 2026. So I want to point out a couple of things. As Tom mentioned, the married people that are married, but they file separate tax returns, and the numbers are not up here. They're very penal toward that. I mean, because that's another move that people started making early when IRMA came out, is they said, well, I'm the one that makes all the money, so I'm going to file a separate tax return than my spouse, and then my spouse is going to at least get out of IRMA. And they've fixed it so it doesn't work that way. And if you go into the show notes, all of that's in the show notes, or you can just call us if you're that kind of people, and we'll work through this and give you an estimation of what this is. Now, another thing I wanted to point out is what we've added up here is we've put the extra IRMA, or the IRMA charge for your Part B. Then everybody pays 202.90. All the 100% of the people on Medicare pay the 202.90, but 8% of the people on Medicare pay this additional amount. So we've added that in. And then IRMA also comes in on Part D. I mean, people that are in the high income range, they're paying more typically for their IRMA part of Part D than they are to the insurance company for the Part D plan. And regardless, this gives you the totals that are paid to Medicare. And for the people in the highest income categories, they're paying $93.71 per person on Medicare. So in a couple, that's, approaching 20 grand. And this doesn't include the cost of a supplement, which is going to be a couple grand a year, or maybe more if you're in some expensive states. And then it doesn't include the money that you actually pay to the insurance company for your Part D drug plan. You put all that in there, it's probably 12 grand a year per person at the highest levels. And it's not that much less than that in the, which are still high levels, people that are couples that are, $300,000-$400,000 of income or more. So this thing is substantial. What I am going to tell you, it's not worth rearranging your financial planning and rearranging your retirement. So we're teaching it to you. We're going to get in a second here to some things you can do about it. So we're going to certainly consider, if you come to us for financial planning, we're going to consider all of this stuff, but we have to balance it against other financial planning strategies. And sometimes to implement one strategy, we've just got to accept some IRMA. So we'll get into that later, but it's substantial. And it's not my job really to teach you or to instruct you how you're supposed to feel about this, because I get that love letter for my wife and myself every year. It's coming pretty soon. And it just is. And if I can tell you this much, is $1,000 a month for everything. And mine isn't quite that, but let's just assume it is $12,000 a year, is still, I was paying for group insurance just for me, $1,500 a month before I turned 65, and for my wife, $1,500. So we were paying $3,000 a month for insurance with a pretty large deductible. So when it's all said and done, this is excellent insurance, which is Medicare, for less money than you could buy it through your business or out on the open market. Again, I'm not trying to make you feel better about it. I'm just trying to teach you about it, prepare for it, and then we're going to get into what can you possibly do about this. And so we're going to talk about appeals, and just generally with an appeal, what people come in and they say, oh, I did a Roth conversion during that year, or I sold my house, and so it was a kind of a one-time event. I just want to appeal it, because that's not something that's, you can't appeal IRMA based upon tax moves that you made in a prior year or that you're not going to make in this year. That it doesn't matter to the Social Security people. The appeal is about changing what's used for the timing. So everybody is getting evaluated by the computer. They're going in and they're calculating their MAGI from 2024, applying it to this, and just sending you a letter. There's your IRMA. So what we're going to appeal is because of this life event that I've had. So we've had a life event, and I'm going to appeal to you to change the timing. So instead of using the 2024 return, I'm going to appeal to you to use my 2025 income or perhaps my 2026 income. And that's what we're doing in the appeal, is just move the timing. And then when you look at me here, I'm going to look a lot better in terms of the IRMAA chart. So I want to push it to Tom, and Tom is going to show you actually how you can go in and do this appeal yourself. We still would recommend that you get with us or some other professional before you file this appeal, but I want to push it to Tom, and I want Tom to show you how you can go in and actually fill out the form online.
Yeah, I mean, I think, and this is an area that we help a lot of our clients with, right? Where they get this letter, and because we've been working with them, they know it's coming. We have a plan for it. I will say, don't try to file an appeal for the IRMA until you actually get the letter assessing the cost, because Medicare is not going to know what to do with an appeal if you don't have anything to appeal, essentially. So wait till you get the letter. That's when you file the appeal. Historically, we had to print the form out, fill it out. And back when I first started, you actually had to take it in to the Social Security office. I mean, which was not much fun. Or you mail it in. If you mailed it in, who knows where it went. And then they sort of introduced where you could fax the form in, which was better than going in person, right? And mailing it. At least we have a confirmation that it went through. And then recently, I had a client tell me they could upload it online, which was again improvement. And then this is just new. And I don't know how long it's been around, but we're just finding out about it. Is you can actually file the appeal online as an online form, which again is simplifying things, and it's going to get right to Social Security. And so let me walk you through how to do that. I'm going to go into my Social Security account. Again, it's not. Obviously I'm not on Medicare, but I can show you how to get there. And so you go to SSA.gov is the first step. Once you're there, you're going to click on my account here. I've previously logged in. Hopefully it's saved it. If not, you'll see me have to go through the two-factor authentication. But anyways, you go there. If you haven't created an account, I would certainly recommend you create an account, even if you're not having to file an appeal, because you can get your Social Security statement on there. There's a lot of things you can see. But you click on account home. So it did log me out. So let's see if we can get logged back in here. Again, the first time you're setting up this account, it's going to have you go through all these different two-factor authentication steps. And again,
well, let me bring up something where you're doing that, Tom. Is I've got on the board the life events, and this isn't a full list, but it's pretty close to all of them. Work stoppage, work reduction, marriage, divorce, death of a spouse. There's a few others, but typically we're using work reduction or work stoppage. And this could even be at a, where you're just not retiring till January 2026. And then we're just going to wait till you actually do retire, and we're going to file the appeal. But you need to have one of these things needs to have happened to you. You need to have gone through a life event. And that's the first thing we need to do before we start filing the appeal, is to determine what life event and how we're going to prove it. So back to Tom.
I am in now. So assume that you get logged in and everything's there. This is the sort of the home screen when you're logged into your account. Again, there's other stuff that you can see, like your Social Security statement. If you need to replace your Social Security card, you can do that online. But the section we're going to focus on is this one that says upload documents. If you click on upload documents, it takes you to a screen. You got to follow the prompts. It verifies you are who you say you are, essentially. And then we get here. And so now we're at the section that uploaded documents. You could, if you wanted to print out the form and just fill it in yourself, you could do that and then upload it here. But what I'm going to show you here is if you click on this SSA form, and again, the form number that this appeal is filed on is SSA-44. And so you click on, they got a bunch of forms that we can fill out here. We're going to scroll down and we're going to look for the SSA-44 form, this Medicare income related monthly adjustment amount. You click on that, you hit next, and you can complete this form online, right? So this is I think this will be where we're probably steering a lot more people to, again, with our guidance of how to fill the form out. But I like submitting it this way as opposed to faxing it in or having to go in person. But you go through, again, you'll notice these numbers haven't updated yet because they haven't updated the form. But in the show notes, you have what the new numbers are for 2026. And you go through and fill out the form exactly the same way. Here are the life-changing events that they allow, that they consider that would lead to a successful appeal. To Hans's point, the most common ones we use are work stoppage or work reduction. Again, that's what typically people are doing. They're working, they're retiring, they're going on Medicare. That's what we use. There's sometimes we'll use marriage, right? If we have I'll give you an example. Is I had a client who'd been living and had a committed partner for 15 years, but they had never really taken the step to fully get married, like to legally, go to the courthouse, get the documents, do everything. And then they got looking at this IRMAA. They were committed, all intents and purposes, they were married, but it wasn't legal. So they actually went and got married to help with this. Now, I wouldn't recommend going and get married solely for this reason. That's probably not a great idea. But it is a life-changing event. Another one is divorce. Again, don't plan on divorce, but if it does unfortunately happen, that is a way that you can appeal it. One of them is death. Again, not a great strategy for you to die just for IRMAA purposes. But if you have, again, unfortunately, a spouse that passes away, you can use that. So there's some other ones there. This loss of income producing property is a little bit misleading how they word that. Some people say, oh, I sold my property, your rental property, and now I'm not getting any income. That's not what this is talking about. The loss of income producing property is really referencing if you had say you had a home on the coast somewhere, hurricane came through and destroyed it, and now it's gone. That would count towards that loss of income producing property. But selling the property is not going to count for that. But anyways, you pick the event. Let's just say that I retired. So work stoppage. I put in the date of the event. I'll say I retired at the beginning of, let's do the end of 2025, 12/31/2025. And again, because they're looking at my 2 years ago income, they don't know that yet. They're only looking at 2024. And then I'll go through and I'll pick the year that I retired. I'll put my income. I'm going to say it was 208. I just came under the threshold for the IRMAA appeal. You go in and you said married filing jointly. Here's what I've seen a mistake made here too. So make sure you click the right filing status, but married filing jointly, and you just follow through the prompts. One of the things that you will notice is you hit next is it's going to ask for proof, essentially. What are some proof that you lost your job? So oftentimes you could get a letter from HR or something acknowledging that you're no longer working, or if you're dialed back your hours, you could put there. In absence of that, you can write sort of a cover letter and sign it, like attesting to the fact that this happened. That works as well. But again, you need to provide some proof of the life-changing event, as well as proof that your income is less. And again, a signed letter can work for that too. You upload those files here, and then you just submit it. And so again, it's going to be a much smoother way to do this. It's all online. You can access it through your Social Security.gov account. And so again, I think this would be very beneficial. I'm glad they've introduced this again. I don't know how long this has been around, but it's certainly a better way than faxing this form into your local Social Security office. And so I'll turn it back to Hans. We'll keep going on the board here.
Okay, just keep in mind with the appeal, what you're appealing is don't use 2024, use 2025 or 2026. And typically it's over the fact that you're retired or you lost your job or you changed jobs or something in work stoppage or work reduction. So those are the two things. And it may not be a bad idea to give us a call. If you're calling us about other things, then we're going to throw this right in and we can just talk about it and help you prepare the form so you don't send it in wrong. Okay, next topic is we want to encourage you to think about the RMD effect, required minimum distributions. We get a lot of people that just got onto Medicare, or they're 65, 67, 68, 69, and they're looking at this IRMAA and they're really trying to keep their income below 218,000. And they're trying to do Roth conversions. They're trying to do sell their house. Maybe they have a profit over, or they sell some business, or they're incurring income, but then they're reluctant to incur income because of this IRMAA. And so what we want to point out to them is if you don't deal with a large IRA balance in your 60s and you just wait until you get to be 73, or for some people that are a little bit younger than me, it's 75 is when RMDs hit. And if you just leave your IRA alone, take as little as possible or take nothing, And then we can show you in the computer on a projection what your required minimum distributions or RMDs are going to be on a growing account by the time you reach 73 or 75. And we can show those, and then they're going to start and they're going to go on for the rest of your life and the rest of your spouse's life. We just want to point out that you need to take the long view when you're looking at this IRMA planning, and it might be better off incurring some IRMA now, of pushing against this balance to get into one of these zones, going ahead and paying the IRMA to prevent a lot of IRMA later on. That's really the effect. Tom?
Yeah, I mean, we see this a lot of times, especially people maybe didn't know about IRMA. They get their first letter, they're quite upset about it, and so now they do everything they can to avoid it in the future, which is understandable sort of reaction to getting a surprise bill, essentially. The problem with that, especially if you have a large IRA within that 401k money that hasn't been taxed yet. And the government is going to say, when you get to a certain age, you have to start taking money out. And so if you have large accounts, those type of accounts, you have an IRMA problem. It's just, do I pay it now or pay it later? And so what we do through a lot of our planning is trying to smooth that out, right? Maybe we pay some now intentionally to avoid higher ones in the future, where if we just ignore it completely and we wait till RMD age, those account balances keep growing. We've had great run up in the market the last several years. Let's say that continues. Now we wake up one day, this account has doubled in size, and now the IRMA is forcing us into these higher brackets, which we don't have a choice over. And this gets even worse when the death of the first spouse. So if you're married and one spouse dies, now you got these IRMA brackets on the board here, is you go over to the single tax filing brackets there. And so your income really hasn't changed that much. The RMDs are based off the account balance. The account balance hasn't changed when the first spouse passes, but now these brackets have essentially been cut in half on these lower brackets, right? And so that can be a problem. And so again, it's something that we want to think about, not just today, but also into the future, and make sure that your RMDs aren't going to cause more pain down the road by trying to avoid some pain now. So again, a lot of tax planning is looking at sort of long-term taxes owed. And again, IRMA is essentially a tax, as opposed to each individual year trying to minimize the tax for that one year. Again, something to consider if you have money in tax deferred accounts, IRAs, 401ks, 403bs, those type of accounts.
Okay, spread Roth conversions over a number of years. That's obviously an IRMA strategy. Maybe you're going to use the top of the beginning of IRMA and work backwards from there. But, for some people, you're leaving a lot of money on the table of the 24% bracket. So all we're saying is typically people that are in their 60s are going to spread that over a number of years till they get to RMDs. But there are also people, like Tom was saying, that just stop. They call the stop on Roth conversions because of IRMA. They just say, well, I don't want to do Roth conversions. It's going to make me pay IRMA. And the thing I want to point out is IRMA, when you do a Roth conversion and you run your income up, let's say in 2025, let's say right now you're doing those, or you already did them this year. Sure, you're going to pay more IRMA in 2027 because of that, but that's just going to be for 1 year. And you've helped lower your income. We're back on the RMD effect during RMD period, because that's not going to count. They don't have RMDs. And if you do pull money out of there, it's not going to count out of a Roth. So all we're suggesting is to understand these and some moderation in your planning. Big swings is not really necessarily helpful. Timing investment gains before Medicare. When we do financial planning for people that are, say, 60 or 61 or 62 or even in their 50s, we can, they haven't retired yet. They're coming in. Maybe they've been waiting. Maybe this is you. Maybe you've been waiting till you get a little closer to Medicare and a little closer to retirement to come in and see us. There's a lot of things we can do between now and Medicare to moderate this and maybe get some of the Roth conversions out of the way, get some out of the sale of the business out of the way, and we can get that income recognized and taxes paid on it, so that when we get to Medicare at 65, we're going to be in much better shape with with Irma. And then obtain spending funds from tax-free sources. So if you've done some of this planning and you have money in Roth accounts, you've got cash value in life insurance that's tappable, and you've got non-qualified accounts or money in a brokerage account, money in a business, money in just savings. And so you don't have to pay taxes on principal. You do pay taxes every year on the growth if it's not capital gains. And so it just, all we're pointing out is when you live partially off of money that's already can come to you partially taxable or tax-free, what that can do is just lower your taxable income or lower your MAGI. So there's some levers we can pull. There's some long-term planning that we can do to moderate the expense of this or the cost of this. I want to push it to Tom for some final thoughts on that.
Yeah, I mean, I think, and Hans mentioned this early in the video, is, when we're doing planning, we shouldn't make all our plans around Irma, but we shouldn't ignore it either, right? It's a factor. And so we don't want it to be the end all be all, do everything around this. But if we're doing planning, more holistic long-term planning, and we can minimize some of this cost, maybe drop down one Irma bracket or two, depending on where your income is, then we certainly want to take advantage of that. But a good example is Roth conversions, right? And when we look at the plan, it very well could be that Roth conversions make a lot of sense for your long-term plan. But by doing that, you're increasing your income in the year you do the Roth conversions, which could have an impact on the IRMAA, right? And so you're having to balance these things against each other. And that's where sort of the holistic planning is very helpful, is where we can look at all these aspects and figure out how best to position you to make sure your long-term plan is the most efficient and successful that it can be. One other sort of planning sort of idea here is when we know that there's going to be a life-changing event, and retirement is a great example, right? We definitively know I'm retiring this date into the future. Well, leading up to that date, we could maybe do larger Roth conversions, right? Yes, you're still working, so it depends on your income from work and those things. But let's say we do those Roth conversions, it drives up your income, which if we don't do anything is going to cause potentially IRMAA problems down the road. But because we know a life-changing event is coming, and if we can dial back your income in the year that that life-changing event happens, then we can help avoid the cost of that IRMAA by using the appeal. So sometimes you can be proactive looking forward, if we catch in time to do things like Roth conversions while you're still working, or maybe right after you retired, as a way to sort of thread this needle of sort of being able to do the conversions but not having an IRMAA impact for at least that 1 year. Now, long term, again, that it's on a rolling basis. Once you're out of the window to do the appeal, then you don't have a life-changing event, then there's no more ability to do that. But that's just an idea of something we've done in the past with clients to help plan around certain life-changing events that we know are coming, and just take advantage of that. And so again, if you have questions about this, reach out, call us. We're here to help. And again, hopefully this has been, you will have a little bit better handle on how the IRMAA works.
So in terms of comprehensive financial planning, I mean, Social Security, where we talked about that, is that they're the ones you get the letter from, and you go on SSA.GOV like Tom was doing. Another thing I want to point out is that, well-to-do people that are having this amount of money right in here taken out of their Social Security check, and then you add the fact that they're high-income people, so they're going to pay 85% of their Social Security is taxable. I have some very well-to-do people that, $1,500 a month, $1,800 a month is coming out of their Social Security checks with tax withholding and IRMAA out of each of their checks. They're not too happy about that, but in planning, we try to help them best we can. This is all about Medicare. The whole show is about Medicare. With long-term care, the thing I want to point out is if you're using your IRA as your retirement and long-term care fund, if you're planning, okay, I got this big account balance, if long-term care happens, I'll just pull it out of there. You're going to run your income way up when you're 80 some years old, and this IRMAA is really going to get you during those years. 401k, IRA, we've been talking about Roth conversions through the whole show and the effect that it has. Income, we help people in financial planning create income, but we're keeping an eye on IRMAA, as every dollar of income that we create out of your investments is going to drive Irma. Estate planning, we haven't really talked about that much today. And, this is an indirect tax or a surtax, Irma is. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.